Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy Live Trading Room, streaming live in YouTube here. We got a very, very exciting morning. A lot of developments in the digital currencies markets. A lot of developments in gold, in silver. We'll take a look at some of these developments that are taking place here, as well as the data that we are using, basically using these fundamentals to monetize it, to trade gold, silver, and Bitcoin. We'll be right back. Welcome back here. We got some fast markets here. Let me just take a look here across the board. Some news came out over the wire. I think I briefly saw it, that one of the major cryptocurrency exchanges, if I'm not mistaken, Binary, was shut down. And so I think it's having an impact on the cryptocurrencies, digital currencies. And we have GDLC down about 9-10 points. GBTC is down about 42 points. Coinbase is down about 3. So it's taking a bit of a hit, so to speak, short term. We'll take a look at these markets here a little later on here. But what I wanted to do here on this segment is to share some data that seems to be coming over the wires here, particularly from Kathy Wood on SEBI Financed, which we're going to review here in a minute. Kathy Wood on SEBI Finance recently focused.
Selling physical products is not the best way of making money on Amazon in 2020.
Bear with me, please. I apologize. So many things are going on here, and I got to do 20 million things.
21. Now, yes, that.
Okay, so on to the
this video
economy
from SEBI Financed, recently focused on the lower than expected employment numbers that came out last week. You can take a look at it on your own time. The lower numbers might be the cause of the Delta variant, you might say, which is supported by the fact that leisure and hospitality areas were flat, even though they had been hiring quickly. Supply chain shortages might be another cause. Computer chip shortages are critical. Manufacturing hours worked were 0.5% down, which is a huge, given that is 6% for the year. Construction employment was also down, which can also be caused by supply chain issues. Another possibility is that the economy may be slowing down. On the positive side, job openings crossed 10 million recently, which means those jobs are open but not filled. They may not pay enough, such as Walmart, which increased pay another $1 an hour and to $16 an hour for 500,000 of their employees. Skill set mismatch is another issue. Corporations are going to have to start training more. Initial employment claims peaked at 6.1 million claims at the worst of the pandemic last spring. Now we're down to 340,000, which is a huge improvement. We're not that far above the levels before the pandemic. Personal income is up 1.1%, which is a nice increase. Testing 1 2. Testing. Testing 1 2. I apologize for that. We're taking a look at Savvy Finance, and why don't we take a listen to Kathy Woods here for a little bit and see what she has to say.
Today, we got an employment report that was very weak relative to expectations. 235,000 increase in non-farm payrolls. The expectation, I think, was around 733,000. And last month, it was revised up to over 1 million. Now, we're trying to figure out, okay, what is happening here? Is it because of the Delta variant of the coronavirus and the pulling back of activity associated with that? Well, I guess this report corroborates that because leisure and hospitality employment was flat. And those numbers had been coming back very, very strongly until this month. So that's a probable reason. Is it because of supply chain issues? We're hearing about shortages, especially chip-related shortages, chips that go into everything manufacturing. Well, here too, we have some clues. Manufacturing hours worked were down 0.5%, which is a very big drop month to month. That's about 6% when you annualize it. So again, a big drop in a real indicator, not being influenced by inflation. Construction employment was also down. Again, there could be supply chain issues there. So we've got Delta, we've got supply chain issues. And then the third question is the economy in an underlying sense beginning to weaken here, away from the Delta variant and the supply chain issues? Well, what I'd like to do in the next couple of minutes is give you what we're seeing in terms of strong economic indicators, and what we're seeing in terms of weak economic indicators, and a hypothesis that, yes, the underlying economy is beginning to weaken in a fundamental sense. But on the positive side, there's a measure called JOLTS, which is job openings. That measure crossed 10 million. There are 10 million jobs out in the U.S. market that are unfilled today. Now, why is that? There are any of a number of reasons. One is these jobs don't pay enough. And you did see Walmart this week increase pay, I think, another $1. I think they're going to something north of $16 for I think it was 500,000 of their employees. So yes, low wages is one. Skill set mismatch is another. And of course, as technology is evolving faster and faster through our lives, this is becoming a bigger problem. We do believe that corporations are going to have to start training and bringing in some of these people who do not have those skills. We've seen corroborating the strong employment report, initial unemployment claims have come down pretty much week by week. So they peaked, just for perspective, at 6.1 million claims at the worst of the.
Okay, I'm not sure if you guys are hearing me in the trading room. We seem to have a lot of technical issues here this morning. I apologize for that, but can you hear me in the trading room? Oh, very good. Thank you.
Coronavirus last spring. And now we're down to 340,000. Huge improvement. And we're not that far above where we were pre-coronavirus. So the 250,000 range. So we're getting back to normal. Lots of improvement there. In the personal income report, we saw a 1.1% increase in personal income. Nice increase. We saw the saving rate go up to close to 13%, I think, if I'm not mistaken. And so that threshold for the savings rate, before the coronavirus, it was in the 7 to 8% range. We're still well above that. So that's consumer firepower that is available. We're seeing in the housing sector, good sales, both new and existing home sales, very good. Although I will say that in the new home sales report, the month's supply of inventory effectively has started to creep up. So that's an interesting nuance. The pricing in housing has been extremely strong. And there's been a little bit, I would say, of a panic buying in some parts of the country because supply has been so tight. And if the month supply now are starting to increase, that will cure the pricing problem, we think. The Purchasing Managers Index was very strong for August. Orders booming, up at 66.7, and that was an increase from prior months. So it's been levitating for quite some time now, as businesses have been scrambling to catch up to consumer demand as their shelves started emptying out. They were way behind the consumer, as I've mentioned on this video, really starting before the coronavirus. They were pulling back on inventory growth and pulling back on capital spending because of an inverted yield curve in 2019 and the China-US trade conflict and saber rattling. So before the coronaviruses, businesses were postured very conservatively. The coronavirus hit, bam, they shut down. Just as with PPP checks, the consumer opened her pocketbook and started spending on goods and started spending at a very rapid clip. Now, I've mentioned before that goods are only 1/3 of total consumption.
I wanted to share this information with you, which really is one of the best fundamentals put together. Kathy Wood is one of the best analysts and finance individuals with a tremendous amount of progressive knowledge, very much into the digital markets that are just exploding. And I wanted to share this with you because I want to show you the process, basically, that I go through, taking into consideration the markets themselves. Once we have seen these kinds of fundamentals, develop, which is really, for precious metals, one of the most bullish fundamentals that we have pretty much experienced, I believe, in the history of these markets. And yet the price is now down about $31 to $1802.70. The thing I want to take a look at is the daily numbers coming into today. Bear with me 1 second, please.
Good morning, everyone. This is Equity Management Academy with a daily silver report for September 5, 2021. Trading instructions. Daily trend momentum 24.17 bullish. The silver futures contract closed at 24.91. The market closed above the 9 SMA 24.17 as confirmation that the daily trend momentum is bullish. A close below the 9 SMA would negate the daily bullish short-term trend to neutral. Daily price momentum 24.78 bullish. With the market closing above the VC daily price momentum indicator of 24.78, it confirms that the price momentum is bullish. A close below the VCPMI daily, it would trigger daily stops and negate the bullish signal to neutral. Daily price indicator. Exit. Longs, sell 1, 24.86. Sell 2, 24.97. Exit. Shorts, buy 1, 24.67. Buy 2, 24.59. Look to take profits on shorts into corrections at the buy 1 and 2 levels of 24.67 to 24.59, and go long on a weekly reversal stop. If long, use the 24.59 level as a stop close only, and good till cancelled order. Look to take profits on longs as we reach the 24.86 to 24.97 levels during the day.
I wanted to share the AI that we have coming into today.
Good morning, everyone. This is Equity Management.
And so if we take a look at the silver market, we're going to be working on getting at least the daily data now automated by Nikki DeRoba, advisor. And we're going to look at the data, and this is the data that basically we're looking at today, which on the left it shows the daily, and on the weekly it shows the weekly data. And if we take a look at the current price of silver, we've come down to a low of 24.26, which is below the daily numbers. And we've come down to a level of support extremely oversold on the daily numbers, and has entered pretty much the bearish momentum on the weekly by trading below the average price of 24.51. Now, the way I use this information is in different time frames. The daily is on the left and the weekly numbers are on the right of the chart, and I combine both to integrate the daily signals with the weekly signals primarily for short-term trading. We use the monthly signals for position trading, or if we can identify a harmonic relationship between them. So we are at an extremely oversold condition in the silver market, and either the market from here is going to come down to the level of support on the weekly, which indicates at 24.07. And we'll see what the trigger point is at that point. But it is entering also an extremely oversold condition on a weekly basis. What we want to see is either the market come down to activate the level of support at 24.07, and the algorithm will let us know at that point basically the direction of the momentum of the market. It doesn't really matter the reason for the market coming down here into these levels here, whatever the fundamentals were that brought the market down into these levels here are already discounted in the price. The price is a consequence of the momentum of the market. We're going to be taking a look at the monthly numbers here as the week progresses, but primarily what we're looking at is at the silver market right now at an oversold condition, and we're looking for either the market to trade above 24.51 to activate a bullish trend momentum, or a buy signal trigger and a close above 24.59 once again. Let's go back here to the gold market. Gold market obviously has broken the 1810 area, which is a major area of support, and it has entered into the weekly area of support, which is showing extremely oversold conditions daily and weekly. 1810 is a major pivotal point that can be used if it closed below, but this kind of a market here is very difficult to trade when you get this sell-off in the market, which primarily is paper selling. It's pushed the market to the extreme level of speculation that the VCPMI is identifying to be now into the weekly numbers. So if you were carrying a futures position here, 1810 below was a level of protection. If you're carrying multiples or you want to add to your positions, you're in an area where the algorithm is indicating that this is the area where, first of all, you don't want to sell into this. Even though you get this kind of what I call spoofing in the market, you don't want to sell into this. What this is now saying, what the algorithm is saying basically now, is that this area potentially can be an area of accumulation of supply. From a probability point of view, mathematically, if we talk about the standard deviation, it's about 90 to 95% now, 50, 90, 50, 95% relative to the implied volatility of the mean, which is at 1823. So what we want to allow is for the market to trade these levels, to trade the speculation that's down here, and to identify the buyers with strong hands that will take this supply, regardless of what it is, off the market. So let's watch the market here a little bit and see what it does. Let's take a look at some other markets here. Coin down about 79. Copper down about 4 cents. New low on gold, 1797. So the strategy that basically I am applying to this market right now is that I'm holding a long-term position in the gold market and using these levels here to accumulate, as the price indicates to be extremely oversold now, even on the weekly basis. So depending upon your profile, here's where you may want to add and accumulate assets that are not on margin. Most of the gold shares and gold stocks obviously have been battered this morning. Let's take a look at GDX. The gold miner is down about 79 points, down to 32.48. And this is a perfect example of what I said earlier, that trading the markets on the fundamentals are totally contrarian at this point. When you take into account the tremendous amount of stimulus that is expected to come into the market, regardless of the political rhetoric, which is really one other reason why I believe the market is down to where it is right now, is because they're still negotiating the $3.5 trillion stimulus package back and forth. It has become politicized when the economy seems to be doing the opposite of what they're suggesting or what they're recommending. So the markets right now seem to be in a bit of a corrective pattern. Coming back, obviously, after the holidays. The paper markets were rated this morning, obviously. And, when we take a look at, there's absolutely no reason why this should happen, except that we get a lot of selling from central bank pressure, commercials, which really take out the stops at these levels here. And once they spoof the market, they take out the stops, the market finds the solid buying that is continuing to be in the gold market, which is buying on a long-term basis. Any corrective moves in the gold market is being taken advantage on the long term. Continue to be patient here. I think we're coming into a level of, again, extreme oversold condition in the gold market on a daily, a weekly basis. And what we want to see here is the market turn around and get back up to 1810. And that would be a very, very strong signal. Thank you again, my friends, for the opportunity to share this information with you. And we're together on this. Stay tuned, and we'll take a look at the rest of the data here as the week progresses. Have a great trading day. Take care of yourself. I'll talk to you soon.